Now they can hear us.
All right, now we're up.
I still never don't have the timing on just right.
We're getting there.
I'm working.
You're doing good, my friend. You are doing great.
Flipped it too much.
We need a third person in here.
We do.
We need a volunteer.
Well, actually, I've been told I'm at least 3 or 4 people in my brain.
Yeah, at least.
There's at least a couple people up there.
Yeah.
All right, what you got for us this week, Jerry?
All right.
Welcome to the show, by the way, everybody.
Yes, Labor Day.
This show is brought to you by Narragansett. Did I say that right?
Narragansett.
Narragansett.
Yeah, Narragansett.
Actually, Jerry and I are going up to, where's that at?
Narragansett is in Rhode Island, but
okay.
it's right just south of Hull, Mass. We're going up to Hull, Mass, which is on the south side of Boston.
Where Jerry grew up? Is that where you grew up?
Yeah, pretty much.
Okay.
Yeah.
All right, I get some Boston.
It's my happy place up there.
Yeah. We're going to go up do some wheeling and dealing. All right, man. What you got?
Yeah. Okay. So, quote for the week comes from my favorite Stoic philosopher, Epictetus. Wealth consists not in having great possessions, but in having few wants. So we could take that quote in a whole bunch of different directions, but I think it's kind of applicable to this week because of the craziness of the market this week.
Was kind of crazy.
I mean, we were talking about 3,400 being the level, the support level, because that was the prior high from February.
Yeah.
And once we got past 3,400, we went right past it to 3,500. And then at some point, like Monday, Tuesday, whatever, we were up at almost 3,600. And then everything came collapsing back down. And it actually did dip below 3,400, but closed on Friday back above the 3,400 level. So we're going to get into all that on the charts. And I know we talked about how candlesticks was a bit of a teaser. This was definitely the week to talk about candlesticks. So we're definitely going to do that because when the it was a week of huge price swings. So we're gonna look at what that looks like on a candlestick and how you can just see from that one image all this different information.
Cool. And then we're going to go watch the Kentucky Derby.
Oh, yeah, there is that. Yeah, there's definitely that.
That's why we're starting off with Narragansett.
Narragansetts. All right. So, yeah, wealth consists not in having great possessions, but in having few wants. So if you really want the market to keep going up, right, because we've had this series of all-time highs, and your expectation and your wants is that the market keeps going up because you've already spent the money in your head that you're watching, you're probably doomed to failure. You're much better off, like we talked about the last couple of weeks, having a game that you know how to play and be in it for the sake of playing the game, not being in it for the sake of trying to relying on the gains that you make in the market.
Kind of the way I was thinking about it was that regardless of your risk tolerance right now, this is getting risky, right? I mean, you're kind of at the end of the
risk, market risk.
Any risk tolerance level,
right? You're
probably close to the tip of it.
Yeah,
right.
This is market risk, the epitome of market risk. Yeah, and actually, we're going to talk about that in the next slide because I got one really good question a couple days ago from one of our new subscribers about that, and he was asking me when I was getting ready to retire, or like how close I was to retirement, and how I can't remember the question exactly, but the gist I got from it was how do I manage my money now if I'm close to retirement, right? And so we're gonna talk about that at the end. But let's go to the market this week. So as I'm sure if you're watching this show, you're watching the market at least to some extent, so you know that tech rolled over really, really bad. Apple, Google, Amazon, Tesla, like any of the tech names, they all rolled over really bad. And
because they've been carrying the S&P for a while, right?
Yeah, since the bottom of March. I mean, this has been
absolutely. So a lot of people think that the S&P 500 has been doing well. That's not the full story. It's really the tech portion of the S&P 500 has been really carrying it, right?
Yes. So the beauty of trading indexes, which is what the C fund is the S&P 500 index. It's 500 largest U.S. companies. It's called market cap weighted, so market capitalization weighted. So that's kind of a good thing and a bad thing. So what market capitalization is, Basically, the way you figure out the market capitalization of a stock is it's the number of outstanding shares multiplied by the share price. So as the price of Tesla is not in the S&P 500, much to Elon's chagrin, but Apple, Amazon, Facebook, the rest of them are in the S&P 500. And so as those prices go, exponentially higher, their market cap goes up, and the more valuable the company is, the more influence it has on the S&P 500. The more of a bigger piece of the pie it takes up in the S&P 500. So what ended up happening since March, when everything basically collapsed by the end in March, but then coming off that rally, tech was not the whole rally, but it was the majority of it, and so it took over as controlling the majority of the S&P 500 move.
Which makes sense
index.
when you think about everything needed to go virtual.
Oh, it all makes sense.
Almost immediately.
Right.
I mean, if you have a software as a subscription model, SaaS, if you have anything remotely like that, right, which is all the tech companies. So that the fact that happened isn't that
no, it's
surprising.
definitely to be expected.
Yeah.
I mean, you saw Zoom went up 45% in one day this week.
Yeah.
I mean,
it's amazing.
It's crazy.
Yeah.
And I don't have a chart of it. I wish I did, because I was looking at it here earlier when it did go up, and it was absolutely foreseeable. I missed it, unfortunately.
It happens.
My personal account.
You're too busy looking at the indexes.
The indexes, yeah, that's true. But if you looked at a chart of Zoom, it had consolidated in an ABC four step. It was clear as I looked at it in hindsight. I'm like, oh man, how did I miss that? But yeah, I missed it. So anyway, the S&P 500. So tech is the big chunk of the S&P 500 now, and that became super clear here with this fall off, because the index also rolled over, but not as much. Obviously, at some point, I think Facebook and Apple were down close to 10% in one day at one point this week. So that was the C fund. The S fund got hit actually harder than the C fund, as you would kind of expect, because the S fund is smaller companies, and it's mostly tech. So S fund got hit pretty hard. However, the S fund reversed off its 50-day moving average. So there's a lot of really interesting stuff in these charts. So I'm not going to talk too much about it right now, because when we get to the charts, you'll see it. iFund, similar kind of thing. The iFund, we were talking about how it's in a base on base consolidation right now, and it's still within between 66 and 64. It closed above 64 on Friday, so it's still within that horizontal consolidation range. But it was down. So the C fund was down for the week. S fund was down for the week. I fund was down for the week. The F fund, right, the bond fund, was the only fund for the week that was actually up. But if you look at the chart, it's the worst chart, right? And you're like, how is that possible? How is it possible that on the face of it, CS and I are down, F is up, but F actually performed the worst.
Right.
You can only see it in a chart. You can't see it.
You're going to show us why that happened.
Oh yeah, and you'll get it. It's pretty clear in the chart. Yeah. So bottom line is, overall, the market held some pretty key support levels this week. Next week is going to be important, because it held the levels this week, mostly because Friday was a pretty good reversal day. We really need to see what happens on Tuesday. Tuesday, Wednesday. I mean, and
the good thing is we're only going to be on a plane for like an hour and a half to get from here to Boston.
So that's true. Not too much can happen.
We can't miss it. It's too much of an hour and a half.
And we're going up to you can say New York is the finance capital of the world, but really Boston kind of runs the show.
I thought Charlotte was the banking capital.
Banking. Sorry. Nah, we don't need banks. On a side note about the banks, Warren Buffett. I was reading a thing today, and there's a couple articles if you want to Google it, if you're a Warren Buffett geek. His company has to make public the big trades that they do, and he just put out the trades that he's done basically in this year, 2020. he's coming way off of all his banking stocks. It's really pretty interesting. If you Google around, there's a couple articles out there about the 20 biggest moves he's done, and Bank of America, PNC, like a whole bunch of bank stocks, he's really trimming his positions in. So we'll see what that does to the bank index next week. But anyway, okay. So overall, held some pretty good support levels. Next week is going to be really important. And we've been talking about candlesticks here for a while. We're gonna do the deep dive into candlesticks today because you can just get so much information from looking at one candlestick. Once you get the hang of it, it's really the kind of the best way to look at charts.
Okay, and after we do that, you got to promise me this week you're going to help me draw out or write out a cheat sheet.
Cheat sheet,
so that we can put it up on the website because. I'll say at least me. I'm going to forget half the things you teach me about candlesticks. I need a cheat sheet.
Yeah, well, the next chart is actually a cheat sheet. So
nice.
we're gonna talk through it. And then after candlesticks, like I said, we're going to swing back to that the question about
retirement,
time, retirement, and that's why I have risk and quote here. We'll get to it. I think anybody who's been following the site for a while understands why I put risk in quotes. And we will get to it. Okay. So this is what a candlestick looks like. There's a bullish candlestick and a bearish candlestick, right? So a candlestick is when we do daily charts, each day is one candlestick. So my pen here.
Right. So any length of time you're doing, if you're doing a by minute chart, each candlestick's going to be a minute.
Yes.
If you do a daily, it's that. If it's monthly, it's a month.
Yep.
Okay. So
if you have a 1 year chart where each tick is a day, it could be a dot, it could be a line or whatever. We're using candlesticks here, right?
Got it.
So there'll be 365 candlesticks in that 1 year chart.
Got it.
Okay. So if you're first we're going to just look at one candlestick. Okay. So, and then the next chart is actually going to be the C Fund weekly, and you'll be able to see it kind of in real time. So a couple of really important things. The body is this part right here. Okay. When the body is filled in, okay, you got the open price right here, the price where it opened, and you get the price where it closed. If the price where it closed that day or over that time frame, let's just call it a day, right? If the price where it closed that day is lower than where it opened, the candlestick is filled in. Okay? If the opening price down here is lower, so meaning if the price went up during the day and it closed higher, right? Closed up here, then the candlestick is open.
Because that matches up with the bear market versus a bull market. Bull being going up, bear being going down.
Right. So when you look at the charts and you see long candlesticks, long bodies in the candlestick that's filled in, right? It means the price opened high and tanked during the day.
Big tank.
Big tank, right?
Right.
Now, let's stay on the bearish one for a second. Let's say the price opens up here and then runs higher during the day and gets the highest it got during the day was here. And then it rolled over and got all the way down to here at some point during the day and then finished back up here, closed for the day at this price. Okay? So you just got a ton of information in there. The price opened here. At some point during the day, it went higher. You don't really know when. This isn't an intraday chart. It's telling you what happened.
Could it have gone lower before it went higher, or is that would be the other bullish candlestick?
No. Let's say at 9:30 the market opens, right?
Yep.
Open right here. Say it gapped down on the open to right here. Then by 10 o'clock it was down here. Then some good news came out. Something happened, whatever. It went running back up.
Boom. Okay.
Boom.
So it doesn't matter which directions it's going. These are the end results.
Yep. That's
What
you get
drives it.
You get in the opening price, the closing price, the high price, and the low price.
If it closes less than it opens, it's a bear candlestick.
Yes, it's filled in. It's bearish, meaning you lost money that day.
Right.
But it's filled in. And it's just the reverse on a bullish. It means the price closed higher than where it opened. Okay. Everything else is the same. Got that?
Got it.
All right. So that's just, you're looking at one candlestick. So the only other piece to this really is how the candlesticks relate to each other. So in this here, you got the body is black, and on the bearish side, and the body is white, basically on the bullish.
So immediately when we see the filled in one, we know that it closed lower than it opened. That's immediate.
Yes, that's immediate.
And then if you look at one that's not filled in, you go, oh, it closed higher than it opened today.
Right.
Okay.
So that's relative to the day.
Mm-hmm.
This is a snapshot of the one day,
Mm-hmm.
right? So that's like the basic candlestick cheat sheet, okay? Here's what it looks like on the current C Fund 9-month weekly. So each one of these candlesticks represents a week's worth of trading, price moves, okay? So on Friday, the market opened a little above 3,500 right there. Okay, on Monday, because this is the week, right?
Mm-hmm.
On Friday, it closed right there at 34.26. Does that make sense?
Yep.
Because it was a bearish week, right? During the week, it opened here. At some point during the week, it got up to about 3,600. And then, as we know, by Thursday, it had collapsed all the way back down here to below 3,400, but then reversed and closed up here at 34.26. Okay, so a lot of movement happened during that week.
Mm-hmm. Now the tails, can you go back to the slide right just before this? So if the tails are longer or shorter, let's use the bearish again since we were using that. So if the low never got below the closing price, right? It was the same. Then there's not going to be a little tail. Then
Correct.
It's just a flat. Because I noticed that some of them are flat at the top or bottom.
Right.
That's because the high or the low didn't go beyond that.
That's
right. Okay.
Yep.
Just making sure that I'm thinking right.
Yep. No, you get the idea. And the rabbit holes you can go down looking at the different patterns and what they mean of candlesticks.
Yeah.
I mean, I would highly recommend it if you have any interest, because there's some really interesting things. Let's just say as we're I think we can talk about it while we're looking at this chart right here. Imagine if
you want to go back to the chart?
Nah, I'm going to leave it here for a second.
Okay.
Imagine if on one day the market goes down. It's got your bearish candlestick right here, right? The next day you have this bullish candlestick where the closing price finished at the high. So it was higher than the day before's opening price, and it had no tail at the top. That's showing you a huge positive reversal, right? So now you'd want to give it one more day to confirm it, but that is like a buy.
That's an indicator. Yeah.
It's a huge indicator. So
that's a lot of information in one little.
It's
yeah.
I mean, that's why I use it. It's a ton of information, and sometimes it can be overwhelming. I mean, we've talked about the dots. Like a really simple way to do this is if the dot, which is the closing price only, if the closing price is above the 10-day moving average,
right,
the market's going up. You can stay in. That's a very, very simple way of
right. It's not enough information to put all your eggs in that basket.
Right.
But it's a great, quick, visual representation of the market's still going up.
Yeah.
But there's not a lot of info in there.
There's not a lot of info there. It's a dot. There's a lot of info here. Okay. So the only other really important piece of this is looking at it relative to the other days, or in this case, weeks in the chart. So in the last slide we were looking at, the body filled in is black on the bearish day, and it's clear, white, or whatever the background would be on the chart
Yeah.
on the bullish day. Okay. But now you look at this chart and you go, wait a minute, all the down days are filled in are red. Why is that? Right? They're all filled in red except this one right here. I say days, I mean weeks. We're looking at a weekly chart, so hopefully we won't get confused. This one too, I didn't see that. Every other bearish day, except for where those two arrows are, the body is filled in red. The reason is because it's filled in red when the price closes below the previous day's price. It's relative to the previous day. It's not relative to itself, or week, whatever. So I'll say week, because we're looking at these charts of weeks. So this was right here, just over 3,500, was the close last week. This week's close was 34.26. This week's close is lower than last week's close. That's why this week is red. Okay. So this does get tricky. This week right here, it's got a very short, very thin body, but it's black, right? Why is the body black? Because the closing price, right there, it's basically open and close at the same price. It was higher than the closing price of the week before.
The week before, yeah.
Okay. It doesn't happen all that often. It obviously didn't happen a whole lot in the last 9 months. But that's what that is. So, and it also can go the other way. You could have the whole candlestick could be red with the body being white.
I was going to ask you can you have the other version of that?
Yeah. So if the candlestick is red, but the body is white.
Meaning not filled in.
Yes, not filled in, right? The week itself, let's say the Monday, the market closed, let's say it gapped way down for the week, right? And it opened at say 3,000. And then it closed at 3,100. So it was a positive week. And that's what we're looking at. It was a positive week. So it would be, it would not be filled in because that week was positive. But if the whole week was lower than the prior week's closing price,
then it's going to be
a red candlestick with the
not filled in
body.
Because the given week, it was an up.
Right.
But compared to the previous,
it was down.
It was down. Well, that's a lot of info.
It is. It's a lot.
Yeah.
A lot. And that last little thing we just talked about, by the way, is a huge bullish move. Right. It's basically capitulation. Ooh. It's showing that the market threw in the
I'm
towel.
gonna have to Google that word.
That's a finance word, but you got to know that one. That's a good one.
Google that.
If everybody threw in the towel and said, forget it, I'm out, that's usually the bottom, and then the market comes roaring back up and closes at the end of the week, at the top of the range, and it's an open-bodied reversal pattern. It's almost definitely going higher from there. So anyway, ton of information in a candlestick. So we're going to stay kind of on this topic as we keep on going through. Unless you have any other questions.
I do.
I'm sure I am not. We probably should have done this and chopped this up into 2 shows because I know there's a lot of information.
No, I think we will do another show about this. Yeah. But I think this is good to give us a little bit of info going forward because I think it's probably something we're going to have to come back to, a few times before it sinks in.
Yeah, definitely. Okay. So this is the daily. Where are we at? Nope, this is the weekly. This is the 2-year weekly. So we just looked at the 9-month weekly. Now we're looking at the 2-year weekly because I wanted to put it into a little bit of perspective. Actually, the biggest reason why I wanted to add this chart was because of the volume. So the the volume, it was a relatively, relative to the last few weeks, it was a big volume down week, right? The interesting thing is, though, if you compare it to some of the other weekly volumes, right here, right there, and certainly back here in the beginning of March when we first came off the lows, this week's volume isn't all that high. So what that basically tells you is, yes, the percent move, the price move this week was significant. There weren't all that many people selling, right? So what I'm saying is we didn't see capitulation this week. We didn't see people throwing in the towel. And one of the good ways to tell that is because we had the reversal on Friday, which is where you get the shadow or the tail, right? And we also didn't make it down to the 10-week moving average. This is a weekly chart, so that's the 10-week moving average. It roughly corresponds to the 50-day moving average. But this is the 10-week moving average, and we didn't quite get down there. So we need next week. Next week is really important because it's going to tell us which way things are really going to go. We have 3,400 right here at this top, and we tested 3,400 here, dipped below it during the week, but closed above it. So right now, the market is showing really good support at a critical level, right? That can be perceived as a very bullish sign. We just need it to be confirmed. So on the one hand, it's great because it got support at 3,400. On the other hand, there's a lot of gravity, call it, down to that 10-week moving average line, and we didn't get there yet. So it's a coin toss right now whether next week is really the market takes off or continues lower. Yeah, I mean, I don't see it collapsing through the 10-week moving average next week. To be honest, if it did go lower and started showing some support at that 10-week moving average, I'd really be inclined to get back into it. Because I think we're probably in, well, I don't know. We'll have to see how it goes. But there's a lot of, you can look at this chart and see really good things, or you can look at it and sort of see bad things, or you can look at it and want to give it another few days or a week. And that's kind of the camp that I'm in. I want to give it another couple of days before I really make a decision about what to do.
Right. As far as this decision whether to be more in the stock funds or less.
Yes.
Yeah.
Yeah. I mean, right now we're roughly 50-50.
Right.
So, yeah, if we get support there and we get the support is confirmed, then yeah, I'd be more likely to get back into a little bit more into stock funds. And the volume is pretty important here, because even if the market especially if the market continued down next week and the volume continued to decrease, those are some great indicators that we're consolidating here for a move higher. If we go, if the market starts coming down, especially if it gets below this 10-week moving average line, and it does it as volume continues to go higher, bad juju.
Bad juju.
All right.
That's a technical term.
It's technical. Maybe we'll define that next week. Maybe not. Okay. All right. So the F fund. How could it possibly be that the F fund is the only positive one for the week and it has the worst chart? So I'm going to put you on the spot. Seems how you just had all this knowledge, data dumped into you about candlesticks.
Candlestick.
So tell me, when you look at this chart, why is this chart bad?
Well, I can read your notes.
That's okay. I did kind of give you the answer. That is true.
I didn't. I was going to pretend, and then I was like, everybody else is looking at the same thing. They're like, God, I just read the notes. But I mean, yeah, if the notes weren't there, that was my initial thought was.
Of course it was.
Yeah, because I hear you talk about it all the time.
Right.
But I mean, we're looking at the 10-week moving average, right? Yep. We're looking at that. I always look at that blue line first. I always look at that the average line that you show, because that's what, really looking from a simplistic point, like we've talked about before. Right. Forget the candlesticks. If you're looking at that and it's dipping below, that's a bad indicator,
right?
Right.
So pulling the average lower.
Yeah. So I first look at that and I'm like, well, it looks like we dipped below that.
Right.
Yeah.
Very true.
So.
We closed below.
And big volume.
And big volume. The
now, what do we consider big volume when it's black down there?
So black means that the week, it was a positive week,
right? Compared to the week before.
No, positive mean yes. No. It opened.
Gotcha.
Wait, let me think. I'm confusing my candlesticks and my.
Yeah, I took you the wrong direction. The red means it closed less than the week before.
Yes,
and the black means it closed
higher than
the week
yes,
before. Yeah.
For volume. So.
And that's clear when you look at all the.
Yeah.
The chart.
The tricky thing about this week, though, with the F fund, the reason it's black is because the price closed higher than it did the week before. So you're absolutely right about that. The problem here is you got a huge negative reversal, right? So while the week opened down here and closed higher up here,
it had been way higher.
Yeah, it had been way higher and reversed all the way back down almost to where it closed at, or where it opened at.
Right.
So, and it got, during the week, it did get above the 10-week moving average, but then it couldn't stay there. It reversed and came all the way back down. So this is a really bearish chart. I mean, it's the only one that finished higher for the week, but it's a really bearish chart. It hit resistance at the 10-week moving average line and couldn't stay above it and rolled over and did this bearish hammer, and it's not good. It's the worst chart of the four. So hopefully that makes sense.
It does.
The volume, even though it's the shaded in area is black, the volume was negative, meaning way more people are selling than buying. So even though the color is black, don't get confused. The majority of the volume of the shares trading hands last week was negative. I would not be buying the F fund right now. Of course, it could turn around next week and explode higher, but I would not be taking that bet. Okay. All right, so it's a little bit easier to see on the weekly charts, but seeing as how the daily is usually what we use to make reallocation decisions, I'm going to roll through the daily charts real quick. So here's the 9-month of the C fund, and you can see we hit almost 3,600 right here on the gap up, and then it rolled right over. Hit the 10-day moving average line right there, kept on going, came down, reversed, closed above 3,400, which is great for us. You got this dotted line is the showing the support from back here at 3,400, and reversed and closed higher than 3,400 here. So it's, as long as the support can be maintained at 3,400, we're in good shape. What we would really like to see is something like this. That's what we want to see. So that's about it for the daily and the C fund. That's what we want to see. But we did have 2 consecutive big volume down days. So the reversal, like I said before, it helps because it keeps us above the 3,400 support level, but not having gotten down here to the 50-day moving average line means we still got sort of some gravity. I don't know how else to say it, but there's going to be some pull on the market next week, and we'll just have to see who wins, the Bulls or the Bears. Not the Mets or the Cubs, but the Bulls or the Bears. All right. S fund got hit pretty hard, but actually I actually like this chart better because it came all the way down to its 50-day moving average and reversed right on it, and reversed almost all the way back up for the day. So Friday was actually a really good reversal day, and it came off of a double top here. We're pretty much right at 1600 on the double top. So again, we need another follow through over the next couple of days, certainly the beginning of next week. And we could see, it's possible we could see the prices come back down, but we definitely want to see support there at that 50-day moving average line. If it breaks below that 50-day, all bets are off. I would not be back into the S fund. I fund, same kind of thing. We are still in. It closed back 64.52. So we're still in this sort of base on base, this horizontal pattern right here. Okay, we're still in that horizontal pattern. It did a really good positive reversal off the 50-day moving average. So actually, the iFund is probably the best sort of looking chart right now. You got a really strong reversal right there, so we could definitely see the iFund move higher, which was why I didn't get exactly if you remember a couple of weeks ago, that big up day was pretty important for me because it took us out of this triangle consolidation pattern right here. It's just that it put us into a base on base pattern, so we'll see what happens down the road. Hopefully, with that reversal on Friday, the iFund keeps going higher. We will see. Okay.
That's a lot.
Yeah, my brain's a little fried.
Jerry's had a bit of a long day before he came here. He flew around the world and back.
Sure feels like it. Okay. Can you think of any questions about candlesticks and how they relate to this week?
No, I think it's a good start. I mean, I think, again, this is going to be one of those topics because, like, right this second, I understand it,
yep.
and I know that we've talked about them before. Yep. So, if you're slow like me, you got to get things 2 or 3 times. But I think it's a good start, and I definitely having a cheat sheet on the website, and also, just coming back to it every once in a while and reminding people like what the things mean, because there's a lot of information in there. And, we hope that folks are taking this as an opportunity to be able to go look at charts themselves, right? And not always rely on other people. And it's not that you have to be able to, Jerry's been doing this for 20 some years, 30 years, whatever. It's more about being able to start seeing things and then validating them with other people's analysis to start making you feel comfortable in your personal risk situation. Right. Is that?
Yeah. After a while, you start seeing, it's kind of like riding a bike. You got to do it a bunch of times. You fall off, whatever. Eventually, you start riding it, and you get it. And once you get it, you can't not get it. You just get it. Right?
Got it.
Yeah.
I know.
So once
I know how to change gears in a manual shift car.
Exactly. Right. You can't unlearn that. Right.
And that'll be very similar. That is a good example of how reading these charts kind of goes. And it's there's a lot of other things that go into that analysis, but at least being able to see the data for yourself, right?
Right.
It doesn't lie.
No, it's right. It's right there. Now it can be interpreted differently.
Right.
But once you get good, especially at candlesticks and charts in general, once you get good at it and you start overlaying the indicators, the moving average lines, and you get the indicators RSI and MACD, and there are plenty of others that you can use. It starts like telling you a story, as goofy as it sounds, telling you a story off the page.
Right. And barring that, just do what I did for like 15 years and just move your money when Jerry does.
Yeah, well, you could do that too. All right. Speaking of that one, the one question I wanted to circle back to. So if you've been following the site for any amount of time, you know that when we talk about risk, it's market risk. The conventional wisdom is that risk is based on your goals and your age and your personal circumstances, right? And the financial planning industry is based on that.
Right. It's built on that premise.
Yes. It's built on the premise that you sit down with the financial planner, we talk about your goals, your personal experiences, where you want to be in 20 years or whatever it is. This is not that. Okay. What we're talking about in terms of risk is market risk. So
Because our basic philosophy is the market doesn't care about all that stuff you just talked about.
Right.
The market's not paying attention to your life.
No, the market doesn't care.
The market doesn't care.
So once you get it that the market doesn't care, you have to do what the market tells you to do, not what your goals are, not what you want to see the market do. You have to do what the market tells you it's doing, right? It's definitely not the conventional wisdom, but the question basically that I got was, well, it was when am I retiring? And the answer is as soon as possible.
It's always the answer.
Yeah.
Immediately.
Right. Now when am I retiring? Now that is like about my personal circumstances, right? I mean, everybody has that. But when I do retire, which it could be within the next 3 months, I'm going to go out on a limb here and say something I probably shouldn't, but it's not going to be later than January 2022.
Yeah,
that is my line in the sand.
And if Conan has his way, it's going to be no later than January 21.
Right. Yeah. Well,
we have a lot more fun
to
be had than for you to be flying around on Uncle Sam's.
Good Lord. Yeah. Anyway, so really what the question was getting to was, as I get closer to retirement, am I going to be managing my money the same way? And the answer is yes. If you are
100% yes.
Yeah. If you are just starting off in your career and you're 22 years old, you're motivated, you're in the government, whatever, you're GS7 or whatever, you are managing your TSP exactly how I am being a year or less out from retirement, and how I will be doing it 5 years into retirement.
Right.
Because the market's telling me what to do, not my circumstances.
Not your personal circumstances. Yeah. Now, the only caveat I think would be to that is if your risk tolerance went so far the other way, meaning I'm not willing to lose a dime.
Yes.
Right? Then
you shouldn't be in this game.
Then just put it in, a safe, money market, a G fund, whatever. Right. Put it in. A checking or savings.
Right. So I mean that's getting into like financial planning ideas.
Right. And that's not what we do. But it is so if you're that far off of it, then this isn't for you.
Right.
One.
But
it's also not practical.
There's a lot of things there. So
why wouldn't you want to still make money?
All right. Well, here's why. You would want to make money. It's just how do you use the resources that you have to make the most money? So I've been doing coaching calls for 6 months or so, and I've heard some really interesting stories from people that, hey, I'm getting ready to retire, and I have these either circumstances or possibilities, right? So let's say I'm getting ready to retire, and I have an opportunity to invest in some real estate that I'm going to lease back out. And I'm guaranteed to make 20%, let's say.
Right.
I mean, guaranteed, if not more. I don't want to get too into the details of this guy's story, but
no, but it
was a great example. So
that's reasonable. I mean, we've seen opportunities like that, and if you have that opportunity, okay, that's right. That's not that unique.
No, it's not that unique. His thing was like, should I leave the money in TSP, or should I use it for this real estate opportunity? And when we talked through it a little bit more, and I'm like, oh, that's a no-brainer. Absolutely take the money out of TSP.
Right.
So there's all kinds of different things you can do when you retire because you have access to the money. But the money that you do keep in TSP that you want to continue to grow, whether it's in TSP or in a rollover to an IRA or whatever, I intend to manage it the same way. I mean, once I roll over out of TSP, I won't have the same 2 move a month restriction, so my money will grow a lot faster. But other than that, it's the market is telling you when to reallocate. It is not based on your personal circumstances, except 2 things. You're not contributing anymore, so any of the losses that you do take, you feel a little bit more.
Yeah. Because
you're not backfilling it all with contributions. That's one. The second thing is, I personally have found as I get closer to retirement that I'm willing to give the market one more day.
Yeah.
Sometimes I get burnt from that. Sometimes it's a smart thing to do, but I've been I've been waiting. I haven't been as aggressive, meaning, if I saw a reversal candlestick, I'd be like, oh, I'm all in on the stock funds. Now I'm kind of going, well, this is a really bullish indicator, but I'm going to give it one more day and just make sure.
Yeah, but I would say maybe that's not just as much about how close you are to retirement, because you theoretically aren't, right? You've said that there's no end date you've definitely picked, even though there kind of is. But the point is that it also may be just wisdom, right? It may just be time, where we all tend to get a little bit more patient and say, let me just let this play out. Let me just take another day. That's different than saying, let me take another week. Right. It's if you take another day to look at the data, that's not necessarily a bad thing, especially when our number one philosophy is don't lose money. Right. And so that philosophy was the same 10 years ago for you as it is today. Right. So maybe you're just more in tune with that to say, let me give it a day. Yeah. And what's the worst that can happen? Not a lot. And if I make the right decision, it's going to be great.
Right. Actually, let me add to that, because you're right. When I say I'll give it another day, it always means because I'm looking at potentially getting back into the market.
Yeah.
When the market drops below a support level that is my line in the sand, I don't give it another day. I am out.
I think we should be real clear with folks, especially folks that are new and to the site and kind of trying to figure out how you do this. I would say that the good thing is that that's always the decision. Like, there's always a line in the sand that says I'm not losing that, and it's out. Right? It's not like, oh, I'm gonna wait it out. No, there's no emotion. Yeah. It's all data. Yeah. It's one of the things I love about you, Jerry, is like, I wouldn't be willing to do that, right? I would be willing. I'm the more emotional guy, and I would be sitting there going, oh, come on, it might, no.
It might. And I've definitely been much better at getting out at the top than I have been at getting back in at the bottom.
Yeah.
But again, it goes along with the idea of rule number one is
there's a lot of us
money.
that have been following you since 2000, early 2000s, that didn't take that huge dump, that loss in 2008, didn't take it, this time.
Yeah.
And that's I'd much rather have not lost that money than made a little, So we kind of got sidetracked there.
Yeah, no, I think that's pretty comprehensive answer.
But
to the question.
the point, I guess, to wrap it up and kind of give a general answer to that is it doesn't change. At least if you're following this philosophy, this way of technical analysis that you do, where I'm at in my life isn't going to determine what the market does.
Right.
So if I want to make money, keep money that I have, right, both of those things, going forward, then I'm going to make the same decisions with what the market does, not with what's going on in my life. Right. Not with whether I got a kid going into college, whether I want to buy a big boat. None of that really factors into what the market's going to do.
Right.
The S&P 500 doesn't change because you know.
Right. I mean,
you got a plan.
What would change is if external circumstances, opportunities came along. So if all of a sudden you really needed a big chunk of money for something in your life, that's an external circumstance that has nothing to do with TSP. That's a decision you have to make.
Right. And you have access to those resources. If you have access to those resources in the TSP and it meets your needs, then that's a decision
you have to make. I mean, I've taken 3 $50,000 loans over the course of my career against TSP. Yeah. People think I'm crazy.
Well, it's a great loan, though.
It's a great loan. That's a whole nother show.
Yeah.
But you take
depending on your personal situation, that might quite possibly be the best loan you could take.
Yes, could be. I mean, there's downsides, but it can be an important. It's a tool. It's like everything else. It's a tool. But as far as the TSP itself, the money that you've decided, based on all the other things you have swirling around, the money you're gonna manage in your TSP is managed the same, whether you're 20 years old or 60.
Yeah, and I think it's important that we say that you're also going to not manage any different, at least for for our site, whether you're retired or not. So whether, again, like I'm not in the TSP anymore because I retired and roll it over. You're going to be in the same boat, because that's, I mean, if you haven't caught that before, that's generally our recommendation. is that don't stay in the TSP because the 2 moves a month, there's not enough flexibility. You're not contributing anymore. You're not getting a match. If you've got all those working against it, and the TSP doesn't like this answer. They don't want to hear us say this. No. But if you have $1 million sitting in the TSP or $500,000 sitting in the TSP, you can do so much better in an IRA because you've got less restrictions, more flexibility, and that's
if one of the what you're doing.
Absolutely, and that's one of the reasons why we've teased this a little bit before, but one of the things that we're going to work on when we go up to Boston is this whole new sort of option for folks that do that roll over into an IRA, and you'll still be able to get the right information from Jerry and what he does to manage that money over there while we still do the same thing for the TSP.
Right. Yep.
Because at the end of the day, we can do it the same. It's the same charts. It's the same data. It's the same decision points.
Yes.
Right. Yep. Did I explain all that correctly?
That's good. It's even a better tease because there's a lot of stuff coming over the next few months.
There is, and we're working really, really hard at giving more value to the current customers, and the new members that are coming on board, so that it's the alert is the thing, right? Yeah. But we want to give more value than that, and we're working really hard to do that. And there's more expansion of this whole thing to folks because we run into this all the time where what do I do after I retire and I am going to roll it over to an IRA, or what if I got out of the gov 10 years ago or the military 10 years ago and it's still sitting in TSP, what do I do with it? And we're working on ways to be able to help those folks.
Yep, a lot of good things coming.
All right. Well, we have gotten a long show today. It's almost an hour long.
Oh boy, that's might be the longest.
And I think the Kentucky Derby is about to go, so we need to get on some mint juleps.
Let's do it.
All right. Thanks for watching, guys. As usual, share this with your friends if you like what we're doing, and we'll see you next week. Hope you have a good weekend and a good week.
Have a great week. No outro.
It's coming. There we go.
Hopefully we have a new outro too here. Relatively soon.
We got somebody working to help us get some new music. But until then, we're jamming out to this.
Very cool.